Picture Wall Street in 1929. Panic, chaos, and the sound of stock tickers clicking faster than hearts could race. Investors were terrified, watching fortunes vanish in days. Amid this financial storm, one man, Jesse Livermore, did the unthinkable. By reading price action on a ticker tape, in an era with no computers, no charts, no real-time analytics, he made over $100 million during the crash, equivalent to nearly $2 billion today. Livermore's genius wasn't luck, it was discipline, patience, and a deep understanding of market psychology. A century later, his principles still resonate. In this video, we're diving deep into 4 timeless lessons from Jesse Livermore and exploring how these principles can still transform your trading today.
Lesson 1. Cut losses quickly. Jesse Livermore, often called the boy plunger, built his fortune and reputation not by chasing every opportunity, but by mastering one essential rule: cut your losses quickly. In his own words, the only thing to do when a person is wrong is to be right by ceasing to be wrong. This was not just theory, it was hard-earned wisdom. Livermore learned early in his career that holding on to losing positions was a trap. The market does not care about your pride, your ego, or your gut feeling. Losses grow exponentially when you hesitate, and hesitation often costs far more than the trade itself. Barry Ritholtz, a respected financial analyst and author of books on market psychology, summed it up succinctly for modern traders. As soon as a trade is contemplated, a trader must know at what point in time he'll be proven wrong and exit a position. This reflects a principle that transcends eras. Discipline in acknowledging mistakes is more powerful than any tip, rumor, or intuition. Livermore emphasized mental clarity over emotional attachment. He knew that the longer a loss lingers, the more it poisons judgment, leads to reckless decisions, and drains both capital and confidence. In his trading, a well-timed exit was often the difference between staying in the game or going bust.
Suppose you buy a stock at $100 and set a strict 5% stop loss. If it falls to $95, you sell. No hesitation, no second guessing. Many traders struggle here, hoping the market will turn around. Livermore experienced this too early in his career, before he learned the hard lesson: a loss never bothers me after I take it, I forget it overnight. But being wrong, not taking the loss, is what does damage to the pocketbook and to the soul. By cutting losses quickly, Livermore preserved capital to exploit opportunities where the odds were in his favor. This approach allowed him to survive market crashes and capitalize on rare high-reward trades, like those during the 1929 crash when others were wiped out. Takeaway: in modern trading, this lesson translates directly into actionable strategy. Set a stop loss, mental or actual, before entering any trade. Define your risk, know exactly how much you are willing to lose. Act decisively. Don't hope a losing trade will reverse. Maintain emotional discipline. A cut loss frees your mind and capital for better opportunities. Cutting losses quickly is not a sign of weakness. It is the hallmark of a professional trader. It protects your account, your psychology, and your ability to seize the next opportunity.
Lesson 2. Let profits run with discipline. Jesse Livermore wasn't a trader who constantly bought and sold just to be active. His real skill lay in patience, the ability to recognize a winning trade and let it grow. As he famously said, "It was never my thinking that made the big money for me. It always was my sitting." Livermore learned early that prematurely taking small profits is one of the fastest ways to limit potential gains. In a bull market, making a 4-point profit might feel safe, but it doesn't build real wealth. He warned, "They say you never go broke taking profits. No, you don't. but neither do you grow rich taking a 4-point profit in a bull market. The core of this lesson is that markets often move in trends, and trends take time. The challenge isn't spotting a winning trade, it's having the discipline to stick with it until the market signals that it's time to exit.
Imagine buying a stock at $50. It rises to $60. Many traders would lock in a quick profit, feeling relieved. But Livermore's approach was different. Trail a stop to protect gains and allow the winner to continue climbing. In many cases, that $60 stock could reach $80, $100, or higher. His discipline allowed him to ride massive moves during events like the 1929 crash, multiplying profits far beyond what timid traders could imagine. Another historical example comes from Livermore's famous shorting of railroad stocks in the 1920s. He identified the trend early and let his position run, resisting the temptation to cash in too soon. The result, enormous profits that built his legendary fortune. Takeaway: let winners run, but do so with discipline. Trail stops to protect profits without exiting too early. Follow price action instead of forcing exits based on fear or impatience. The principle is simple. Real wealth comes from letting winning trades grow. Discipline, patience, and proper risk management allow you to capture the market's largest moves instead of settling for small gains.
Lesson 3. Distrust tips and rumors. Jesse Livermore was famously skeptical of outside advice. He believed that most tips and hot rumors were traps for the unwary. As he said, "Few people ever make money on tips. Beware of inside information. If there was easy money lying around, no one would be forcing it into your pocket." He consistently emphasized self-reliance in trading. "A man must believe in himself and his judgment. That's why I don't believe in tips." He also famously noted, "Markets are never wrong. Opinions often are." This caution was grounded in experience. In 1908, early in his career, Livermore took a speculative tip from Percy Thomas to invest heavily in cotton. The advice seemed promising, but the market moved against him, and he nearly lost his entire fortune. This painful lesson reinforced his lifelong principle: trust the market's signals, not the opinions of others.
Fast forward to today, the lesson is even more relevant. Forward-looking earnings rumors, stock hype, or viral social media posts can tempt traders into impulsive decisions. Following Livermore's approach, a disciplined trader builds their own analysis, focusing on price action, trend, and volume, rather than relying on hearsay. Imagine hearing a hot tip about a trending tech stock on Twitter. The temptation to jump in is strong, but without confirming the trend with real data, you risk buying at the top or losing discipline. Livermore's experience with Percy Thomas shows that even trusted sources can lead to devastating losses. Takeaway: trust the tape, not your neighbor's guess, a flashy tweet, or a hot rumor. Independent, evidence-based decision-making wins. Base your trades on observable market data, not external chatter, and your results will reflect informed, rational decisions rather than luck or hearsay.
Lesson 4. Control your emotions. Jesse Livermore understood one of the hardest truths about trading. The biggest adversary is rarely the market itself. It is the trader. He said, "The human side of every person is the greatest enemy of the average investor or speculator." He stressed that emotional control is the most essential factor in playing the market, and reflected further, a speculator must control himself. This insight was reinforced by others observing market psychology. Financial journalist Gregory Millman wrote, "A man has to guard against many things, but most of all against himself." Livermore's career proved this principle repeatedly. Even the most talented analysis can be undone by fear or greed. A trader can spot a winning opportunity, but panic can trigger premature exits. Euphoria can prompt reckless entries. Hesitation can turn small losses into catastrophic ones. Emotional instability is one of the most reliable killers of capital.
Consider a trader who sees a stock moving sharply upward. The excitement builds, and they add more to the position, ignoring the risk. Suddenly, the price drops slightly. They panic and sell at a loss. Another scenario, a winning trade climbs steadily, but fear of losing gains causes the trader to sell early, missing out on major profits. Livermore faced these same struggles and overcame them by adhering strictly to rules, predefined stops, and a disciplined approach. Jesse Livermore built enormous wealth by strictly following his trading rules and maintaining discipline. At the peak of his career, his net worth reached nearly $2 billion by today's standards. Yet his life also shows the danger of letting emotions take control. On several occasions, when he ignored his own principles and discipline, he lost everything and went bankrupt 3 times. Ultimately, in 1940, he tragically took his own life. Livermore's story is a stark reminder that skill and experience alone are not enough. Without discipline and adherence to rules, even the greatest traders can lose it all.
Takeaway. To apply this lesson today, build a rules-based trading plan and follow it rigorously. Define your entry, exit, and risk tolerance before executing any trade. Stick to your plan even when emotions run high. Recognize fear and greed as signals, not guides. Emotional discipline separates successful traders from those who fail. By mastering yourself first, you gain control over your trading, protect your capital, and position yourself to capture opportunities with clarity and confidence.
So there they are, the 4 pillars of Jesse Livermore's enduring trading wisdom. 1. Cut losses quickly, because losses unchecked snowball into ruin. 2. Let profits run, but with structure, because sitting with winners wisely builds wealth. 3. Distrust tips and rumors, because the market doesn't care about gossip. 4. Control your emotions, because trading is more mental than analytical. These aren't flashy secrets or shortcuts. They are timeless principles forged under enormous pressure and proven by history. Jesse Livermore didn't have algorithmic indicators, AI bots, or real-time news wires. He relied entirely on price action, market observation, and strict adherence to his rules. This discipline allowed him to make enormous fortunes, but history also shows the consequences of failing to follow those rules. Emotional decisions led to multiple bankruptcies and ultimately his tragic death in 1940. If you found value in this storytelling dive into Livermore's lessons, hit like, subscribe, and ring the notification bell so you never miss a video that blends storied wisdom with modern trading clarity. Tell me in the comments, which one of these 4 lessons resonates most with you? Are you the type who struggles to cut losses, or maybe you're afraid your winners might slip away? Let's talk about it.